Good morning, everyone, and thank you for joining us here at the Bipartisan Policy Center. My name is Dennis Shea, and I am the Executive Director of the J. Ronald Terwilliger Center for Housing Policy here at BPC. Across the country, the cost of property insurance has been on the rise. Many homeowners and housing operators are receiving less coverage despite paying higher premiums, and some are unable to obtain coverage at all. Rising insurance costs also negatively impact new housing construction, exacerbating the already acute housing affordability crisis. As is evidenced by the recent wildfires in Los Angeles, the need to address the underlying drivers of rising property insurance costs is only growing more urgent. The intersection between rising property insurance costs and housing affordability is the topic of a new Terwilliger Center white paper called Rising Property Insurance Costs, Opportunities for Federal Action, which we released today. The white paper examines the challenges facing the property insurance market and the homeowners, housing developers, and operators who depend on it. It also presents a menu of potential options for federal policymakers seeking to help mitigate the impact of these costs on housing supply and affordability. I want to stress that while these ideas for federal level action are ideas for federal level action, none of these policy options are intended to interfere with the nation's system of state insurance regulation. Any federal action will need to be developed with support and input from state and local governments in order to be successful. And we hope the options presented in the paper can serve as a starting point for bipartisan conversations as policymakers look for ways forward. Before we jump into today's conversation, I'd like to take the time to express my gratitude to the Robert Wood Johnson Foundation for their support of the Terwilliger Center's work and for making this paper possible. So I see Kimberly Cornett in the room. Thank you, Kimberly. I'd also like to thank the many organizations and individuals who shared their insights with us, and I want to commend the Terwilliger Center team for their hard work in putting the paper together and contributing to other aspects of this project. We are pleased to be joined today by a group of experts from the nonprofit, trade, and insurance industry, along with the state insurance commissioner, to discuss what's driving property insurance challenges, the impact on housing supply and affordability, and potential solutions. First, we have Caitlin Shagru-Walter, who is Senior Vice President of Research at the National Multifamily Housing Council. She is also a member of the National Association for Business Economics, Up for Growth's Advisory Board, and the Research Institute for Housing America's Industry Advisory Board. Welcome, Caitlin. David Snyder, Vice President of International Policy for the American Property Casualty Insurance Association, is also with us today. He has previously held positions with the U.S. Fire Administration, Pennsylvania Insurance Department, Pennsylvania Commerce Department, and Nationwide Insurance. And I learned this morning that David's the former mayor of Falls Church, Virginia, which is, I think, his most important job. Julie Shayu-Woodward is President and CEO of Smart Home America, a nonprofit organization working at the intersection of disaster resilience, policy, affordable housing, and insurance. She has previously held positions with the South Alabama Regional Planning Commission, State of Alabama Forestry Commission, and Mobile County District Attorney's Office. Welcome, Julie. And finally, let me welcome Scott White, Virginia's Commissioner of Insurance, who came up from Richmond to be with us today. Scott was appointed Commissioner in 2018 and is the President-elect, so we call him Mr. President, of the National Association of Insurance Commissioners, which provides expertise, data, and analysis for insurance commissioners to effectively regulate the industry and protect consumers. So I want to welcome everyone and thank you very much for your participation today. Now I'll turn it over to my colleague, Andy Winkler, who's the Director of Housing and Infrastructure at BPC, to help start the discussion.
Thank you, Dennis. Good morning, everybody, and here in person and online. We really appreciate you being here. I've been looking forward to this conversation for a while. We've been working on the paper that Dennis talked about for about a year now, and have learned a ton about the insurance market, about the insurance industry, and in particular, I want to thank all of you for the input that you provided throughout that process. So the honor of the first question goes to Dave. I was hoping you could just help us in level setting and give us a little bit of the lay of the land on what insurance companies around the country who have been facing sort of rising costs. Some have had to leave particular markets because of the risks that they're facing. You're seeing stories about it. I was hoping you could kind of break down some of the challenges that they are facing. What are these drivers? Because I think we have a natural tendency to latch on to disaster risk, but it's a much more complicated picture than that. So maybe you can kind of break down what insurance companies are facing.
Sure. Well, thank you very much, and thanks to the Bipartisan Policy Center for convening this event today and the work on their paper with some interesting ideas. So when you think about insurance, even though that's the topic of this session, we're really the last link in a chain of risk that starts with actions and inactions by individuals, by government, and by other economic sectors. What is insurance ultimately but the transfer of risk from the policyholder to the insurer, and the insurer charges a premium that reflects that risk. So where we need to be focused, and the paper indeed does focus on that, is what are the risks that insurers are seeing and our customers are seeing, and what can we do to reduce those risks and costs. So let me start through a couple of the things that we're seeing right now in the insurance sector. First of all, the effect of the historic inflation. While it has eased somewhat as a general matter, it remains very high in terms of repair and replacement of everything from automobiles to construction costs, et cetera. And under the insurance regulatory system, it takes time for these costs to work their way into the system. So we're seeing the impacts of inflation continuing to exert pressure on insurance. The second thing that we're seeing is the increase in property values generally, and the increase in building in climate-sensitive areas. Then, of course, we're seeing, as everyone is seeing, the impact of increasingly volatile and extreme weather. We're also seeing, in some cases, where affordability is being wrongly addressed to create availability problems. We're seeing the case, particularly, and I would point out California, where regrettably, the last few years, the pressure has been on suppressing insurance rates, not allowing them to charge a rate commensurate, going back to what insurance basically is, a rate commensurate with the risk that the insurance companies are taking on. So in that case, the affordability issues that we're all dealing with as homeowners and as property managers and as insurers, and by the way, inflation affects all of us in one way or another, as an example. What we're seeing in that case is a general affordability issue being converted into something actually worse, which is an availability issue. I mean, California is like 1/10 of the US insurance market. You would think that insurance companies would want to write more, but they can't write if they can't get a rate that's commensurate with the risk that we're covering. So I'm focusing right now on your question, which are the cost drivers. And again, I would urge people to take a look at the report, particularly in that area. The report done by the Bipartisan Policy Center is very, very good in laying those out. And I've laid out some of them that we're seeing. I hope, though, that we get on to, okay, this is the situation, what can we do to make things better? And I very much look forward to that discussion and the ability of these groups and others to come together to address the underlying cost drivers so we can, in fact, have more availability and more affordable insurance than we see today based upon that long chain of risk, of actions and inactions that have been taken that have resulted in a higher than acceptable risk of loss that then we have to try to manage financially.
Great. Yeah, no, we will definitely get to the solutions part, I promise. But first, I want to turn to Caitlin to talk about, and one other thing, and I appreciate the comments about the paper, because I think we did do a very intentional kind of job in trying to lay out the different drivers of costs. But we also very much tried to lay out the different kind of parties affected by rising costs. And I think sometimes we focus in on homeowners. Many of us are homeowners, and that's where property insurance, that's what we think of. But multifamily providers, apartment owners, also similarly impacted by both rising costs in property insurance, but also other types of insurance. Caitlin, being from the National Multifamily Housing Council, maybe you can lay out some of what your members, you've done surveys of them, and how they've been impacted by insurance costs, as well as other research. Kind of walk us through what are the particular impacts for multifamily providers.
Yeah, sure. And so I would actually echo a lot of what was just said. It almost feels like the insurance problem is like a manifestation of all the problems we're facing in the affordability crisis, and it's really showing up in the numbers. So when you go to build an apartment community or operate one, every little, just like your regular household budget, you have to meet a certain criteria to make the project pencil, to be able to afford the mortgage, to be able to do all of that. So housing providers, what I hear most from folks are property taxes and insurance. I joke around, I never realized I would spend so much of my life talking about those two things. But everybody talks about how they're expensive, and a lot of times it's the insurance costs that are, if their premiums are going up a lot, or they're not able to access premiums, folks aren't able to make those developments pencil. We found on the affordable housing provider side, it's a lot more of an issue because they have tighter margins. Their residents are oftentimes rent restricted in terms of what they can pay. And they just have, they're serving a different population that doesn't have, they're not living in a Class A unit. There are, affordable properties in a lot of climate risk areas that need to be served. And so we're really bumping up against a lot of those affordability constraints. On the development side, there are a lot of costs associated with building materials and everything. On the replacement cost side, that's another thing that is really having an impact on things. The valuation of replacement costs, everything's gone up. In my neighborhood, our houses were all built with aluminum siding. Well, they don't make that anymore, and so now it's composite. So when we had a bad hailstorm come through, everybody got brand new siding. So that was way higher than it would have been 20 years ago. All these costs add up, and they're manifesting in what is being required from the insurance companies, because they want to, they're in the business of making a profit. They're taking on risk. What I love about this report is I feel like for a while with the affordability crisis, I felt like I was banging my head against a wall. People didn't really acknowledge it. Now everybody acknowledges it. Now we're starting to dig into what are the problems. Well, now people are acknowledging that insurance is one of the problems in terms of affordability. But one of the problems we talk about is the reinsurance market. Who knows what the reinsurance market is? And this paper talks about what the reinsurance market is. Policymakers need to understand those terms, and so that's what I really like about the paper, and I'm encouraged that can help us actually address some of these issues.
Great. Yeah, that's a perfect example. So Scott, I want to go back to one thing that Dave mentioned, which is how you balance affordability with sort of access and options. To his point, California, when you impose sort of limits on what insurers can do, how they can raise their premiums to cover the risk that they're taking, you can have the adverse effect of then encouraging them to leave particular markets because they just cannot afford to take on that level of risk. So how do, as a state commissioner, and how do your fellow peers kind of look at the issue of how you balance the affordability of property insurance, but also how do you make sure people have options, that they're actually getting the coverage that they need, not just getting kind of bare bones because that's what they can afford?
Right. Well, first, let me thank you for the invitation to speak here today. This is a great panel, and the paper is well thought out. As I was telling Dennis, it really provides a lot of different remedies, and it's kind of a jumping off point for further discussion like we're having today. And you hit the nail on the head. We always talk about balance, right? We're trying to balance as regulators the cost of coverage, along with making sure insurance companies are in a financial condition where they can pay claims, and that contributes to a safe and sound marketplace. That's the key. I think it's important. Dennis mentioned insurance is regulated by the states. It's unique among financial services in that regard. And as you might expect, some states take different approaches in terms of how they protect consumers through the regulation. So we're talking today about mostly about pricing of insurance risk. California is one of the few states that has prior approval of homeowners rates. Most personal lines operate through what we call competitive rating laws. I believe Virginia and 37 other states have that. So that's the dominant form of rate regulation when it comes to homeowners and also autos in the personal lines market. So what do we mean by that? It's basically, if you're Allstate and you want to sell a product in Virginia, you come into the state and you file your rates with the department, and then you can use those. Now, we do have a checklist. We make sure they comply with law and all that, but we are not approving those in the sense you might expect, like with health insurance. The idea around that, very simply, is that if you have adequate competition, market forces should create competitive pricing, and that tends to work. It works in Virginia very well. We have some of the lowest premiums in the country. And part of that is we have 175 writers of homeowners insurance last time I checked. So it's a very healthy market. The question we get a lot of times is, well, what about everything going on in California or down in Florida? Is that impacting my rates here in Virginia? And the answer is it shouldn't be, for two reasons. If you're a company that's writing in California and you want to, you're not getting the rate increases that Dave talked about, you need to use Virginia experience to develop Virginia rates. But most importantly, it's this competitive rating that's going to discourage that. If you're going to come in there and add more premium on there to capture that, you're going to have competitors coming up and taking your business. The other thing I want to mention is if you're looking at the market I just mentioned, that it's very healthy, that doesn't mean that there are not certain pockets within Virginia, for example, that may not have the same availability or affordability protection. So you might go to the high-risk areas like the Eastern Shore, Virginia Beach. You can imagine it might be costlier there. Companies may be more reluctant to write coverage there. And so that's where I want to talk about what we started last year, which was a comprehensive nationwide data call. It was the largest of its kind ever, and it captured 80% of the property insurance market. It got down to a granular zip code level, so we as regulators know what's going on in every zip code in our state about claims, deductibles, whatever it might be. We can now go in there and see in a certain area, is there concentration risk? Are carriers pulling out of these areas? Are they shifting more of the cost sharing on to policyholders? We did not have this information, most states, including Virginia, until recently. And I've got a team back in Richmond that is going through there trying to identify areas where we can now take maybe some of these remedies that have been proposed, risk mitigation, home hardening programs, and focus it in those areas.
So that leads me to my next question for Julie, which is, so you pointed out our state-based kind of system of insurance regulation also allows states to learn from each other. And I think, Julie, one great example is Alabama, and all the conversations that we kind of had about our paper and asked who's kind of doing this well. Everybody said Alabama, because they've been working on this for quite a while, and it's been a partnership, from my understanding, really with insurance companies to address some of the challenges of rising insurance costs in the state. So could you walk us through sort of what is the kind of Alabama example, and are there others from your work in helping to provide local communities and individuals with that kind of know-how of how to mitigate the risks for themselves?
Absolutely. Thank you for having me today. So we, unfortunately, or fortunately, I guess, had the same insurance crisis that everybody is kind of experiencing now in 2006. So we got an early start. And because of the back-to-back storms that we experienced in 2004, we had Hurricane Ivan, and in 2005, we had Hurricane Katrina. And in 2006, our insurance market did pretty much what it's doing now. We had many companies leave, non-renewals were happening, people's mortgages were in crisis, and a group of thought leaders, a lot of them insurance agents, sat down and basically said, this isn't working, right? We have to sell insurance to be able to have a business. The builders were struggling as well because, they just built back, and 11 months later, they were having to build again. And so as an organization, which was just a group of business leaders and elected officials and code officials that were trying to figure out how to, we joke and say we were breaking the cycle of insanity, right? Because we were building and rebuilding and rebuilding. We looked out to the nation at that time to see, is there a better way? What are the best practices? Who's doing what and what works? And we came across the Insurance Institute for Business and Home Safety. Happens to be 100% funded by the property and casualty insurance market. And their whole job, which is a very cool job, is every day they work in a wonderfully beautiful, amazing research center in the middle of South Carolina, building structures, both single family and commercial, and putting all the really bad weather on them. So they can put up to 130 miles an hour winds, 8 inches of rain, full firebrand storms, and hail. And their job is to figure out, how do we build so that insurance can write the risk and understand what that risk is. And so we, a very long time ago, said, that's based on research. Let's see if we can make it happen. So partnering with the insurance industry and with the builders, we did test cases way back in 2010. And then, and this is going to sound so cliche and so simple, but it really is. We just kind of invited everybody to the table. I mean, we brought the builders and the insurance and the code officials to the table, and we said, this seems to work. It's based on research and science. Insurance pays for this research, so they trust this science. This is what we need to do. So over the years, we put a suite of policies in place that sort of shores up and bolsters and incentivizes not only builders and roofers and insurance and homeowners, but it's sort of everybody at the table going, okay, this is not super expensive. It's pretty simple to do. We just need to do this. And we've gone through stages, and we're not by any means 100% there. The central and north part of our state are still sort of integrating this in. We still have work to do, but it's worked. And so we, as you said, in Virginia, we in Alabama have a pretty stable insurance market, and we've been able to sort of shield ourselves from the insurance chaos that is absolutely all around us. Yes, as in Virginia Beach, right? If you've got those homes that have been passed down over generations, there's no mortgage, they're very old, those have seen the increases that people are feeling in insurance because they're a significant risk. And so, but for the majority, especially in our hurricane zones, our market is stable, and we have a very competitive market. We lead the nation in what is called the fortified home, commercial, and multifamily. Actually, I'll correct myself. Louisiana right now is leading the nation in multifamily. Smart Home has been working with Louisiana since the ridiculous storm seasons of 2021, 22, 23. And they are by far leading the nation in multifamily workforce and affordable housing being built to this highest standard. So we've been doing it a long time, and so now we help other states figure out how to do it. But it simply just starts with having insurance and builders and electeds at the table to identify, here's what our risks are, here's the suite, which is really awesome about the report because it gives you many, many options. And then how are we all going to do this? It always, always comes down to the money. Always comes down to the money. Builders have to make a profit. Insurance has to bring in revenue. And you have to find what works for everybody. But it can be done, and I always say, if it can be done in Alabama, it can be done anywhere.
Great. And that's a perfect segue to our focus on solutions. Dave, let's get to the meat of the conversation. And Scott, maybe we can start with you, because recognizing states and local governments probably have most of the tools or more tools to address some of these issues than the federal government. But what could, from your perspective, be helpful from the federal government, from Congress and the administration, in helping you do your job in making insurance both affordable and accessible to people throughout your state?
Well, I'll start with what kind of conditions we want to foster to make insurance companies want to come into our state. We want to make sure that they feel comfortable of writing in our state, and that's talking about risk-based pricing that Dave mentioned, but also you need a certain level of legal and regulatory certainty, right? So the example everyone points to, well, two examples, Florida and California, I spoke with the former Florida commissioner, and what he said is, you know, in Florida, we know there's going to be a certain number of hurricanes. We do the modeling. Our modeling is pretty advanced, so we can kind of predict how many we're going to get. What became so uncertain for the state was their legal environment. They went out and did a study, and they found that while Florida had 6% of the claims nationwide, they generated 78% of all litigated claims. And so when they took that data to the governor and to the General Assembly, it led to what they viewed as tort reform. And I think if you ask the current commissioner, he will say the market is healthier than it was prior. And the companies are not so much moving away, but some are actually coming into the state. So it looks like that's a positive. I know there's litigation, or there are bills in Georgia and South Carolina that are also looking at this. And then we talked about California. I will say the current commissioner has been very active in trying to remedy some of the laws and regulations that have caused companies to pull out or think about pulling out. And so we'll see where that develops. But when you talk about the remedies, federal solutions, well, what I would say is when you talk mitigation, I think is a big one. I think mitigation is one we think is important. And also there are a number of carrot and stick approaches to better home building that we've talked about. At the end of the day, risk-based pricing, though, is key. Insurance companies need to be able to charge the risk that reflects everything we've talked about in terms of inflation, reinsurance, social inflation that I just mentioned, labor, whatever it might be. I also think the flip side of that is folks have to realize that the cost of their house also includes the cost to protect that. And I think that's not always, I know when we bought our first house, that's not the first thing you think about, but as insurance prices increase, I think there needs to be more transparency. I think there needs to be more awareness of really what the overall cost of the home is.
Yeah.
I could just
yeah,
go
go
back
ahead.
to the social inflation thing, because I've heard anecdotally from our members that the tort reform efforts in Florida are starting to matter. There is, Georgia's another one that's mentioned a lot. There are places where people just as a society don't seem to get the concept of money when they're awarding judgments. Somebody said offhandedly, you know, $1 million is nothing to a jury these days, but these are things that people have to pay. And so just general awareness to that, you know, this is impacting your ability, juror, to get a premium, because there is a trickle-down effect. So I think things like that, just bringing that to the consciousness are helpful
And
too.
I'm going to also add on that homeowners, if you have been able to buy a home, right? You buy the home, you close the mortgage with insurance, and the majority of homeowners don't really look at that insurance policy again. You know, that insurance comes into the email or it comes in by paper, and most people just make sure that ACH deductible doesn't make them have heartburn, and then they just keep going. And so they don't really go through their deck pages. They don't take the time to understand, what am I really covered for? Do I have enough insurance? Right now, and I mean, you've seen this, it's bearing out in every disaster that happens. The majority of Americans are so underinsured right now. So they aren't really insured enough to recover. Insurance is economic resilience. It is the easiest and quickest way for a homeowner and even a renter to quickly recover and start moving forward when something really bad weather-wise happens. And I promise, if I sat down with each one of you in this room and went over your deck pages with you, I would identify places that you are underinsured and you don't know. And then you're not going to know until you're affected. And that is what we see play out every single time we have severe weather events right now, and for the last 10 years. We homeowners don't think about our home as our largest investment, and so we don't maintenance it like we do our car, and we don't think about what would it be like if we couldn't use it again. So can't get a rental home very easily if you don't have the coverage to take it on. So it's a very significant underinformed issue.
Well, I want to stick with that, and I might take you up on your offer to sit down with me and walk me through my insurance. But I think you also have to understand, for that to be kind of successful, as a homeowner, you have to understand the risk that you have. You have to have good information about the risk. And there are many, many people post-disaster who say, well, I was told I'm not in a flood zone.
Oh my goodness.
Well, I was told we wouldn't have an earthquake, or that I didn't need a more fortified roof for hail damage. So in places where they weren't expecting to have the level of disaster that they have had, how do you make sure that homeowners have the best information about their actual risk for their property?
That is a hard one. That's like
That's why I gave it to you.
that's like that's like saying yes. Everybody should probably get an annual checkup. So, I mean, everybody in this room is very busy, right? We are all balancing the fact that we go to work or we have families and we volunteer. So, you know, insurance is just that automatic thing, so we don't think about it. Weather comes, weather goes. Everybody that hasn't experienced it knows it's never going to happen where they live, right? We don't have that kind of weather. I think, I feel like there needs to be sort of like this call out to Americans to say, just pause for a minute and ask, what are my weather-related risks? And then I always say when I'm speaking to any group, I always make everybody raise their hand if it's rained at their house, ever. And then I ask if they have flood insurance. And when all of the hands go down, which is the majority of every room, I always say, if it rains at your habitational structure, you are at a flood risk. No matter who's told you what, you are at a flood risk. That is just the reality. And that is the reality across the entire United States. And a flood policy for someone who's not in a designated zone, and I'm not going to say is like crazy affordable because that's not true for every household, but for households who can, it's very affordable. And if you don't have flood insurance, you don't get covered. I mean, the crisis that is in Western North Carolina, there are families there that will not recover because no one was in a flood risk zone. But all of that was flood. So that means their homeowner's policy is not covering that. And so if they don't have, and who has that kind of money in the bank? I mean, I work for a nonprofit. I mean, you know, there's a statistic that not many people in the United States have $500 in their account that would help them with a short-term crisis. Imagine if you had to rebuild your entire life and you didn't have insurance for it. That's happening every day when we have severe weather events, every day.
So it was interesting. We've done a couple of rounds of surveys at NMHC. We're getting ready to put out another one on insurance next week. The first time we did it, we asked folks what their biggest claim was. I was expecting it to be something related to one of the storms. This was in the aftermath of Hurricane Ian, was when we had it. It was Texas. It was the freeze. It was everybody's pipes burst and flooded their whole unit. And you have a house, you have to worry. These are folks, they have to worry about their hundreds, thousands of residents. And for a lot of my members, they own properties around the country. I mean, there has been quite a bit of an awakening for folks that, this is really problematic.
Yeah. I want to stick with you for a minute because one thing I think we focus on a little bit in the paper, because it is an area where there's a clear sort of federal nexus to insurance, is in affordable housing, right? And HUD in the last administration tried to do a few things to make insurance a little bit more affordable. But I was wondering, Caitlin, if you could kind of build on what the federal government could do in the space of affordable housing, where it's actually providing a lot of the resources to develop. It has loan programs, it has LIHTC, tax incentives, everything else that's really required to make an affordable housing development pencil out. And they all have insurance requirements, right? Mm-hmm.
Yeah, I mean, so affordable properties are getting hit on the property side as well as the liability side. And so it's a lot at the moment. I will say property seems to have gotten a little bit better, we're hearing, but it's still high. And so some of the things that you guys recommended in your report, we're hearing a lot of issues related to underwriting standards from folks. Just a recognition that, this is going to hit people's operating budgets. And so how, lender, federal lender, how are you going to work with us on that? That's a big thing. On not just the affordable side, the NFIP, the mapping. I mean, we have, to Scott's point, we're starting to get all this data. Like as a society, we're getting data. our maps are not up to date. So if a provider can go and see an affordable provider that does not have a lot of, financial resources to hire all these brokers and everything, if they can go and find a reputable map provided by the government, something as basic as that would be super helpful.
Dave, you haven't jumped in yet on solutions from an industry perspective. I know you're not asking for a ton from the federal government, but what are some potential areas that would be helpful for insurance companies?
I think you've already heard some great ideas, and let me just build on those ideas. But let me take a step back. The price that is charged for insurance, as I said at the beginning, reflects a lot of actions and inactions taken at far higher links in the chain than just insurance. So let's talk about some of those. First of all, we've already mentioned that there's a challenge for homeowners to understand their risk, and we're engaged in working to try to help make that more apparent. Lenders have a critical role here to play at the point of sale, and some lenders are doing this now at the point of sale, talking about the potential exposure to natural catastrophes of the property. So it's not just proximity to schools, for example, the traditional positive things or the other positive things about home buying, but now people need to consider their risk exposure for natural catastrophes. And we're starting to see some interesting developments there. So when we really talk about solutions, the problem didn't arise from a single cause, and it will not be solved by addressing one element. We realize we as insurers have a role to play, and we can talk more about that. But so one example of progress from another sector is what lenders are starting to do, so that insurance is no longer a tick-the-box exercise, but rather something that all elements of the lending industry need to be engaged with us and with consumers to better understand their risk at the point of sale. Then you've heard already the example from Alabama, which is now part of a national model law put out by the National Conference of Insurance Legislators. And it has these component parts. First of all, a standard for mitigation that is not just the standard, but includes verification and ongoing maintenance, the IBHS standards that were talked about a minute ago. These are standards that the insurance industry believes are founded on science and will actually reduce the risk. And then using that standard, the state then provides mitigation grants to individuals, and that can be based upon need and particular circumstances like we talked about. And then the insurance industry provides actuarially justified rate discounts. So that's a model now that's available for the states, and we think that's a key part of the solution. But let me go over to the role of government. So first of all, government needs to use the regulatory authority that it has. Government, federal, state, and local, depending on how it's divided, needs to use their authority to improve building codes. We can no longer, as we've learned, regrettably, we can no longer build whatever we want to build, wherever we want to build it. So we need to take a serious look at building codes and whether they're enforced or not, and ensure that they're enforced. We need to look at land use, zoning, for example. What we're learning is nature-based solutions can have a very positive impact on reducing losses from natural catastrophes by restoring barrier islands to being barrier islands, for example. So there are those elements of government, federal, state, and local, depending on how they're divided. So government, all levels of government, needs to be a partner in the effort to deal with this. As I mentioned a minute ago, other economic sectors, for example, lenders and builders, also need to be a part of the solution. And the Alabama situation is part of that. Insurance regulators need to be a part of that solution, and they need to continue to do what they do well in most states, which is to make sure that our rates are tracking our losses and work with the industry to educate other elements of state government as to what the risk is and how to reduce that risk. All of this is to say, however, the insurance industry has a critical role. Number one, our role is to send important signals about risk in terms of actuarially based pricing. But it should not stop there and does not stop there. We need to continue to fund the best science to look at where the losses are occurring and what are the best solutions to those losses. And the Insurance Institute for Building and Home Safety is an example. On the auto side, the Insurance Institute for Highway Safety. Then we need to be advocates working with government to fully use government's regulatory authority. Then finally, let me end up with the federal role, because a lot of this is state and local. We believe the federal government has a key role to play as a convener. For example, last year was approved a set of recommendations to improve wildfire prevention, response, and recovery. From my own experience with the U.S. Fire Administration, in the very early days, the National Bureau of Standards came up with a standard for smoke detectors. Again, a federal role, but then the requirement to put the smoke detectors in was added to building codes and enforced state and locally. And as a result, I would say hundreds of thousands, if not millions of lives have been saved from fires. So that's just a little example of the critical role that the federal government can play as a convener, as a supporter of research and a coordinator of other economic sectors and other levels of government, so that we can, one by one, attack these drivers of costs that are resulting in higher than anybody, including the insurance industry, higher than anybody wants to see in terms of insurance premiums and sometimes the related availability issues. So the saying goes that it's darkest before the dawn. Well, we're in the dark right now. I mean, who could not be moved by the pictures of the people barely getting out with their lives in the California wildfires, or first responders pressed beyond human endurance? These are things that we can and need to prevent from ever happening again. And that's why this segment today and the report are hopefully a critical part of preventing those scenes from being repeated in the future.
I want to build off that last point, but first, for everybody in the audience, please get your questions ready. We're going to turn over to audience questions, both in person and folks in our virtual audience. They can stick them into our YouTube chat if you're watching online. In just a couple minutes, we'll turn over to those. I want to build off that last point because, Julie, you said who pays is the question at the end. And while we all understand, I think, or there's a growing awareness that building codes and home hardening and mitigation, these are all great things, but who is responsible for making those investments? And if it's the homeowner, some of those are really expensive up front. You might end up saving a lot of money down the line, and maybe even the federal government saves money down the line by avoiding disaster-related costs. But maybe you can walk us through sort of that rationale, and how do we get to a place where we collectively decide how we're going to pay for these things and whose responsibility it is.
I get the complicated question.
Yeah, that's why I'm giving you all the hard balls.
So we talked about state commissioners regulate, insurance industries run the risk. So every insurance company either does their own risk modeling or they have a contract, and they set those premiums based on what is the risk of loss that they're looking at in every state and every region of that state. California insurance companies have not been able to use modeling for fire. It's prohibited, right? So how do you know what you need to charge in order to cover your risk? In some of our southeastern states, for years, depending on how the commissioner looked at regulation, they would put premium increase, but it would be stopped, right? So if you're raising the cost of insurance, but you're not mitigating the structures, that cost of insurance is going to keep coming up. Dave's mentioned, insurance will go out of business if we can't afford to buy it, right? So they're very vested now in the conversation about we have to mitigate. So if I'm a homeowner and I get told that I'm not going to be renewed, my insurance isn't going to be renewed because my roof is too old, but my roof's not leaking. So what do you mean it's too old, right? And I don't have a storm, so I didn't get it replaced by insurance because I paid my deductible, which a lot of homeowners will wait until there's something that triggers that insurance product. Where am I going to find that money, right? So you're right. It's always about the money. So when Smart Home America started really digging into this, it became very, very clear. And I'm going to say this, and I know that somebody's going to misquote this, but you kind of have to pay homeowners to do the logical and intelligent things to their home. And what I mean by that is they either have to have an affordable insurance policy that they're willing to pay for, or you have to give them some sort of an incentive and help them make that next better decision. Because it's just not feasible unless it's there. And so, as Dave mentioned, in Alabama, we have a no-match grant that is managed by our Department of Insurance. And it's a first come, first serve. It's opened on that first business day of each quarter. That money gets tagged in less than 30 minutes. We have almost 60,000 structures in Alabama that have met that IBHS fortified standard. Only about 3,000 or so are from the grant. But because there was seed money to help homeowners who couldn't qualify for a HELOC and refinance or borrow to re-roof, they were able to get enough of that seed money to get them over that hump to re-roof. They then saw that insurance reduction, and so there was a financial incentive for them to make a decision that they wouldn't normally do unless they had an insurance claim. Insurance, of course, stepped in and said, okay, this is working. We had the data after Hurricane Sally. We had over 17,000 structures that 95% of them didn't have any claims. They got through the storm. In one municipality, non-fortified structures, there were 3,000 roofing permits after that, and that's one jurisdiction. So one, if you're a homeowner, and I never really answered your other question, and you want to know about all this, okay, the people in the room and on YouTube really are at an advantage here, but most people, if you ask them, if you did one of those polls on the street, they wouldn't even know there was a Department of Insurance. We have a Department of Insurance. So the Department of Insurance in every state has a website. Nobody knows this. And it has really great information on there, and it links to really great information. The Insurance Institute for Business and Home Safety, the III, is an insurance, and I say the name for me, it's the Insurance
Information
Institute. I never say that correctly. There are plenty of places that homeowners, but here's an even crazier one. Your insurance agent. Nobody really spends the time with their insurance agent. Insurance agents tell us all the time they cannot get homeowners to sit for even 15 minutes. So they can't tell you what your risk is. They know what your risk is because they know what they're writing and they know what they potentially are going to pay out. So ask your insurance agent, actually sit and talk to them. I mean, back in the day, we brought them to dinner and had them at the house, right? So talk to your insurance agent and find out what your risk is. What kind of insurance do you need to cover yourself with so that you can actually recover and be economically resilient?
Great advice. Anybody else on solutions real quickly that we haven't talked about before we turn to audience questions?
I guess there's one more role that I think government in particular needs to play, and that's infrastructure. Frankly, too often decisions are made that shortchange infrastructure. So we're getting needless flood losses because the stormwater systems aren't brought up to current requirements. Funding of first responders. We need government. A true partnership is where each partner uses the expertise and the tools that they have with the other partners to achieve the desired result. And so government has some unique capabilities, whether it's infrastructure, funding, response and recovery, creating and enforcing building codes. That role has simply got to be played. Other economic sectors are beginning to step up. That's critically important as well. And we in the insurance industry have a role to play, not just to price on the basis of risk, but demonstrate and work with the other sectors and government to reduce the risk that's being transferred at cost.
No, that's a great point. And I think we've focused a lot on what the individual can do, but particularly in cases like wildfires, right? If your neighbor isn't also doing what you're doing, you're still at risk. So it's a community level response, not just up to the individual.
Yeah, I mean, absolutely. And not all mitigation is terribly expensive. I mean, for example, if you create the defensible space around your house, just simply moving anything that's flammable 5 or 10 feet away from your house, that can be tremendously important. But there are certain hazards that are community-wide, and there's got to be a role for individuals doing what they can, but also as advocates within their communities to make the entire community safer, as well as, again, better understanding their own risk and being advocates for reducing risk posed by the entire community.
I would just add one last thing. It's almost a shift in mindset from, it's not that it could happen to you, it's that it will likely happen to you. I mean, we all drive our cars thinking that at some point in our life we're going to get in a car accident. At any given time, there are flooding events around the country that are impacting places, West Virginia right now, that didn't historically have in that area. So you might, to your point, the mitigation is not as expensive as what you're going to pay in the aftermath. I mean, the quotes for the California damage are very high.
And I know we need to go to questions, but I'm going to back Dave up on the fact that I'm going to back him up and disagree at the same time. We have good building codes right now. We have some of the best building codes we've ever had. Jurisdictions need support from state and federal government to enforce those codes. We have the codes, they are good codes, and where they're adopted and enforced, and enforcement is the key, where they're put in place, they simply work. Look at the areas after Hurricane Ian in Florida where codes were enforced, they worked. And so we have good codes, and they get updated every 3 years, but the local jurisdictions do not have the budgets they need to properly enforce.
So why don't we start, does anybody first in the room have a question? If so, please raise your hand. Someone will bring over a mic, and please ask your question in the form of a question and identify yourself.
Hi, everybody. Adam Hawes. I'm a fellow with Senator Tina Smith from Minnesota. Great panel. Excited to read the report. I'm curious for everybody here, as well as what's in the report, on what do you think is possible from federal congressional legislation in a bipartisan manner right now, assuming that there's not money to be spent, which does not seem to be a popular bipartisan proposition right now. So I'm curious, but I like the idea of convening. I think that's probably more of an agency role than Congress. So curious, what do you think, kind of, if you couldn't have Congress appropriate any money or incentives for this space, what do you think Congress should be doing?
I can.
You want to jump in?
So Minnesota's stepped in and doing a good job. They have been for the last 2 years trying to stand up a grant program, that no match grant for their citizens. They had a little bit of seed money to start it and to start moving it forward. Homeowners that qualify for that grant right now run the risk of paying taxes on it. So that is not an incentive for a homeowner to do something great in reducing the risk of their property and possibly getting better insurance coverage if they think they're going to have to pay. That's going to reflect on their federal and state taxes. So I think that's an easy one, right? If you are actively making an intelligent and logical decision to reduce your individual risk, and you have garnered state-supported no-match grants, that should not be taxed.
I would add that we, as state regulators, we do monitor federal legislation, and that's a big one where, if it's a federal grant program, it's not taxable, but if it's the Minnesota program, other state program, it is. And that seems to be an easy fix, but it's one that seems not to get much traction. And I think you're right. If you take away the federal funding through the mitigation, that's a big piece where Congress could play a role. You are kind of left with tax incentives. You could provide a 30%, there's a bill that would provide a 30% tax credit for any mitigation activities. That's one avenue. They can also incentivize and foster research programs around mitigation activities. So again, you take away the funding, you're much more limited, but there is opportunities out there.
I'd like to just further support both comments. I think tax exempt mitigation accounts would hopefully something that the Congress will consider favorably. Another area is management of federal property, to making sure that the federal forests and others are being managed in the most up-to-date scientific way. Funding, to the extent possible, is fundamental, the carrot, if you will, to assist other levels of government to do what has been traditionally assigned to them, building codes and building code enforcement. That point was made critical as well. I mean, that's the very least, and the additional element is do no harm. That is, look at federal policies that may be inadvertently increasing risk or increasing the cost of risk.
That's a great.
Yeah, I would just add one last thing, back to your database point earlier. I'm clearly the researcher. I'll geek out on data here. Like, finding a way to get more data in the hands of people that is representative of the U.S. as a whole, like everywhere, would be very helpful. The one part that you have to be very careful about is this do no harm aspect. It can be very onerous on reporting side of things. If you're adding costs for the insurers, if you're adding costs for a housing provider, where they're already, speaking for my housing provider folks, they're already stretched so thin, and you have to pay these people to do this, and collect this data. So finding some sweet spot where everybody at the table can agree that this data is needed, and it sounds like we're pretty much almost there. I mean, back to my maps, like that.
Everything.
Yeah.
Everything over the last 8 years has been mapped with LiDAR technology to a soil of sand. So we know where there is a potential of flood. We know how to mitigate, but local governments can't get that data. They can't use that easily. Consultants have it, and consultants will work with you as a local community. But then it goes back to, where do you get that money to pay for that? Getting that information into the hands of local communities would be very easy and very powerful in helping them plan. You have to pay to plan. Local communities do not have the resources it takes to properly plan. They know they're going to get hit at some point. They have to have a plan in place, and it can't just be in place, it has to be codified. It has to be voted on and approved so that it actually is enacted, and the federal dollars can make that plan happen post-event. It always comes down to the money.
We have, Dave, you already mentioned these, but a question from online. Do you have any thoughts on the Ready Accounts Act, which seems to have some bipartisan traction, and whether mitigation savings and or catastrophe savings accounts should be considered as part of an all-of-the-above response to property insurance challenges?
The answer is yes.
Yes. Everybody, yes?
Yes. Yes.
Okay. Any other audience questions? We have time for just a couple more quick ones. Don't see anyone. Another question from online. In areas facing acute property insurance affordability challenges like Florida, what are some practical steps that can be achieved quickly, especially for older adults on fixed incomes?
I think, first of all, work with the insurance company to see what they're seeing in terms of risk. Work with your local government to make sure that, as advocates, to make sure that they're doing what they can to reduce community-wide risk. But it's communication, and then hopefully there'll be some cost-effective steps that can reduce the risk that are affordable even for people on fixed incomes. And of course, in a competitive market, you want to shop for the best insurance pricing that you can get. So those are the kinds of things. It's mostly dialogue. Dialogue, as was mentioned, with your agent or with your insurance company, to see what you can do within your budget. And another area of interest from the insurance industry is to allow our policies to be more flexible so that we can better provide coverages that people want and that they can afford. So that's another area. Look at those options that are available from insurance companies to reduce premiums, and what incentives there might be for risk mitigation.
Any other quick final thoughts?
I would just add from a knowledge perspective, there are a lot of great products out there that provide free estimates of, and unfortunately we have a lot of experiences. So if you're a community, if you're a local government, there are some great products out there that provide, estimates of this is where it is. You can look up demographics of your population, so you know where to go, unfortunately, when something happens, and already have that planned out.
It's great advice. So unfortunately, we are out of time. I want to please join me in thanking everybody on our panel for their expertise. Thank you all for joining. Please do check out our report. Particularly Emma, Rebecca, and Laura on our team put a lot of time into it. Hopefully it's some really good information for folks, and reach out if you're interested, and find our page online and follow all that we do on research and events. We have a lot coming up. So thank you and have a good day.